Tesla's revenues have tripled in 5 years, but the stock price is right where it was back in 2021 January. So what's going on? In this video, we'll break down the numbers, cut through the hype, and ask some uncomfortable questions. Is Tesla still a great investment, or has it become a hope trade? This video is for informational and educational purposes only. It does not constitute financial, investment, or other professional advice. Always do your own research or consult with a qualified financial advisor before making any investment decisions. Let's start with the positives. If we review Tesla's balance sheet, then we see that Tesla has about $37 billion in cash and short term investments against $5 billion in long term debt and about $5 billion in long term leases. So it clearly has more cash than debt. And this is a really strong balance sheet. Tesla's revenues grew from 31 billion in 2020 to over 95 billion in 2024. That's a compounded annual growth rate of about 24%, which is phenomenal for a manufacturing company. Now, this is not a fluke. It reflects real ground level execution. But here's where things get a little tricky. Gross margins have dropped from the mid 20s to just 17.6%. It suggests that price cuts, competitive pressures, or perhaps cost inflation, whatever the cause, the result is clear. Tesla is making less per car than it used to. And that's before we get into free cash flow. Tesla's free cash flow margins have fallen from about 8 or 9% down to just 3 and 4%. This isn't unexpected. It's a manufacturing business with a heavy capex and working capital needs. So even though the top line looks great, the cash that shareholders actually benefit from is getting squeezed. Tesla trades at an eye-watering enterprise value to free cash flow of 145 times. That's not just expensive, that's priced to perfection. Analysts expect Tesla to grow at about 19 to 20% annually over the next couple of years. Let's say analysts are right and revenue grows about 20% for 2 years. That will take us to about 140 billion in revenues for FY27. And let's be generous and assume that Tesla gets back about 10% in free cash flow margins. With about a $1 trillion in market cap, Tesla is trading at 70 times its FY27 free cash flows. To justify today's price, Tesla needs to grow free cash flows at 30% per year for 10 years. Maybe that happens. Maybe robotaxis and humanoid robots become the norm. But as an investor, I prefer businesses based on current reality, not a fluffy fantasy future. And that's why I'm staying away from Tesla. Not because it's a bad company, but because it's priced like a miracle. So, what do you think? Is Tesla a once in a generation opportunity or a stock priced for sci fi dreams? Let me know in the comments. And if you want a deep dive into companies like Snowflake, Uber, or any other, then do hit that subscribe button. Until next time, invest wisely and not emotionally.